Hey everyone. Um, while I'm social distancing here and sheltering in place here at my house, I wanted to make a video um, to briefly explain what financial ratios are. So we've looked at how the financial statements are developed by recording transactions within the context of the accounting equation. And then the numbers that have developed within that equation are reported on the income statement to show the profitability of the company over a period of time, typically a year. And then the totals within the accounting equation are reported on the balance sheet to show the financial position that the company is in at the end of the year. And then we looked at the relationships of how those financial statements are connected, primarily by looking at the totals. So now we're going to look at some of the specific items within the financial statements and how we can, by relating particular items within the income statement and the balance sheet, we can glean some information about the financial performance of the organization. So I'm going to just look at a few sample ratios. There's lots of ratios that you can look at, and we're just going to look at a few. So let me get my picture out of the way. And first of all, let me just talk about the company's operating cycle. Here's a timeline representing the day-to-day activities of a business. If you think about it, we buy inventory, and then the inventory essentially sits on the shelf until you sell it. And if you sell it on credit, then you're going to have to wait a certain number of days until that money is collected. We would call that the collection period. So what's interesting is by analyzing the numbers on the financial statements, we can actually estimate the average length of time it takes for this operating cycle, the components of this operating cycle to happen. If we look at the income statement, we're going to use the sales and the cost of goods sold numbers. And if we look at the balance sheet, we're going to use the accounts receivable and the inventory. So first of all, we're going to look at inventory turnover. How long does it take the inventory to turn over? Throughout the period, the inventory is constantly being sold and replaced, sold and replaced. And so kind of, if we look at that in total, that would be the turnover of the inventory, the product. So we calculate inventory turnover by taking the cost of goods sold, which represents the total inventory that was sold during the period, and dividing that by the inventory that is sitting there at a point in time, which is on the balance sheet number. So cost of goods sold divided by inventory tells us how many times the inventory has turned over during the period. And I'm fixing to look at the solution for this. You could stop the video a second and calculate that. But if we take the cost of goods sold of $600,000 divided by the inventory of 115, it indicates that the inventory is turning over a little over 5 times a year. And if we divide that into 365, that's about 70 days per turn. So that's just kind of on average. And the question is that good? Well, it depends on what industry you're in. Is it a durable good, or is it something that will spoil quickly? And also, what is your target? How quickly do you want to turn it? We could address the turnover. We could quicken the turnover a couple of different ways. First, we could target the numerator, that top number, which represents how much inventory has been sold during the period. And we could enlarge that number by selling more inventory. So we could target our marketing efforts, our sales prices, our advertising, commissions perhaps, specialty promotions. So there's different ways to move more product, and that would increase the numerator. Or we could also address the denominator and simply carry less inventory on hand. And so by addressing the numerator or the denominator, we could improve the turnover. I should note that numerator, cost of goods sold, another number on the income statement, the sales, also represents the product that was sold during the period. But it includes, it's measured in sales prices, and cost of goods sold is measured at our cost, which is more comparable to the inventory number. So that's why we use it. So in this example, the inventory is turning over about every 70 days. Now let's look at the collection period. Again, we're going to compare the total sales we had during the period, which in this case was $750,000, and compare that to the receivables, how much is due from customers at a point in time. We get that from the balance sheet, accounts receivable. And so if we compare the 750 sales divided by the receivables of 90, it represents the receivables turning over, meaning collected and replaced, collected and replaced, collected and replaced, a little over 8 times a year. Divide that into 365, and that gives us an average collection period of 44 days. So if we add that to the 70 days that it took for the inventory to turn over, it gives us a total operating cycle of about 114 days. And again, you can ask, is that good? And we look at that in its components. We've already looked at whether or not the 70 days was good. On the collection period, if you're sending your bills out and given a due date of 30 days, then a 44-day collection period is not very good. It could be that we're just being too loose in approving credit, and maybe we need to tighten up that policy, run a better credit check on customers. And there's other ways we could try to encourage them to pay early as well, maybe given a discount or something, but that could be expensive. Anyway, the inventory turnover and the receivables turnover, those are two examples of how we can use the numbers on the financial statements to gain insights to the performance of the company. We call this financial ratio analysis. So I'm going on the next tab. I have a few other ratios that we're going to look at. And to calculate these ratios, I have pulled the numbers off of the January 31 of 2020 financial statements for Lowe's Corporation. And I got those by going to the website for finance.yahoo.com. And on the Excel file that is provided to go with this video, you can read these instructions about how to get those numbers. So what I've done is already calculated some ratios for Lowe's, and I'm asking you to stop the video and pull the same information off for Home Depot, calculate the ratios, and do a little bit of a comparison, thinking about the components of those ratios to answer the questions over to the right. So you may want to stop the video as you do that What I'm going to do is go to the next tab and just proceed through a discussion of these ratios. First of all, we're looking at the current ratio. The current ratio compares the current assets on the balance sheet to the current liabilities. Current assets are those assets that we are constantly using up in our day-to-day operations, not running out of them because we're constantly replacing them. But current assets are those that are just used or consumed in day-to-day operations. We've already looked at a couple: inventory and accounts receivable. Cash would be another current asset, maybe some of our prepaid items, prepaid rent, prepaid insurance, things like that. But by definition, a current asset is an item that will be used or consumed in operations within the next year, usually much faster than that. Current liabilities are those liabilities that are coming due within the next year. So if we compare those to the current assets, it gives us an insight to our ability to pay these debts when they're coming due. We're looking at those kind of assets that are cash or close to cash, that will be generating cash. Comparing the current assets to the current liabilities, again, we call this the current ratio. For Lowe's, it's a current ratio of 1, which means that for every dollar of current liabilities, they have a dollar of current assets. Pretty close. Home Depot has a current ratio of 1.1. So for every dollar of current liabilities, they have $1.10 of current assets. So little, pretty close, a little more coverage, Home Depot. We can get a little more focused with our ability to pay our current liabilities if we focus only on those assets that are either cash or extremely close to cash. And we calculate the quick assets by taking the current assets and subtracting inventory, because inventory may take a while to sell it. So since we're removing a significant current asset, the quick assets are significantly smaller. And so the quick ratio for Lowe's is 0.1, indicating we've got about 10 cents of quick assets for every dollar of current liabilities. Home Depot is a little bit larger, 0.3, so 30 cents for every dollar of current liabilities. So again, it's a measure of our liquidity. How well positioned are we to pay these liabilities as they come due? And of course, this is just a static look. In addition to the quick assets, we've got new cash coming in as sales are generated. But it's just a sort of a cutout in time, a cross-section of time, just looking to see how well positioned we are. So it looks like Home Depot has a little more liquidity as we look at these measures. On top of that, if we look at inventory turnover, because within those current assets, a significant item was the inventory. So how quickly is that inventory turning over? We've already talked about how to calculate it, cost of goods sold divided by inventory. Lowe's is turning its inventory 3.7 times in a year. If we divide that into 365, that's almost 98 days turning over, indicating that we're turning over the inventory every 98 days. By comparison, Home Depot is turning over their inventory 5 times a year, or every 73 days. So that's significantly faster than Lowe's. And so it just adds support to that earlier measure of liquidity that we were looking at. So, and again, is that good? You think about the inventory for Home Depot and Lowe's as being very similar. And what should that turnover be? And again, it depends on how quickly we're selling it, but also how much we are carrying. So, the more you perhaps have heard of just-in-time inventory. A lot of companies are seeking to lower their investment in inventory, and that improves the turnover, lowers the amount of dollars tied up in inventory. But you can't be too extreme with that because you don't want to run out of inventory. So it just has to do with that, how sophisticated and how targeted your inventory management system is. And so we just see some differences in strategy there. How about the receivables turnover? Again, we've looked at the calculation of that, sales divided by accounts receivable. And if we look at Lowe's, they don't have any receivables on their books. And Home Depot has a very small amount of receivables compared to their sales. Two things are at work here. One is, both of these companies do take credit cards, and so the customer is not paying yet, but the bank is, whoever is carrying that credit card. So Lowe's is getting their money very quickly from the bank, and it's the bank that carries the receivables as the customer pays that out, perhaps over time. Also, both Lowe's and Home Depot has commercial customers, but Lowe's has an agreement. Looking at their financial statements in the footnotes, you can see that they have an agreement with the bank where they are selling their receivables to the bank. So that's called factoring. So Lowe's does not carry the receivables, and Home Depot carries a very small portion. So their receivables turnover is extremely fast. So if we add the receivable days to the inventory days, we can get a comparison of their operating cycle that we had mentioned before. One other ratio I wanted to discuss is what's called the gross profit ratio. On the income statement, you've got sales minus cost of goods sold is gross profit. Your gross profit represents the markup that you've included in your sales prices. So if you take the gross profit and divide by sales, it gives us an indication as to what is the average markup included in those sales prices. And the gross profit percentage for Lowe's is 32%, for Home Depot 34%. So it looks like Home Depot has a slightly higher markup in their selling prices. So this is just a sampling of some of the ratios that you can use to analyze a company's performance over time, their profitability, and also analyze their liquidity and even their solvency in terms of how deep in debt they are, as we'll be looking at in later topics. So that's a brief discussion, introduction of ratio analysis. So do some practice on that, and then hope you do well on the homework.